Just want to start by saying good morning to everybody. Thank you for taking some time out of your day to join us. As you hopefully know, we do these presentations every month. It is part of our service to your company's 401k plan. My name is Chris Thomas. My firm is 40W Advisors. We have the privilege to serve as the retirement plan consultants on your 401k plan. And the education that we bring to you every month, we hope is something that makes you a more educated investor, saver for your retirement. And we also like to sprinkle in on odd months. We like to sprinkle in some other financial planning presentations. So we hope you'll join us for those. It's not always investment focused, but for this quarter, it is. This quarter, it's the end of, or this month, it's the end of the first quarter. So what we're going to do is we're going to spend some time just recapping what happened in the investment markets over the first quarter. We're going to talk about kind of what happened, the major headlines that investors, retirement savers like yourselves probably heard and might have worried about a little bit. And then we're going to take those headlines and we're going to translate them into investment lessons that we think are important for everybody to understand and be aware of. Before we get started, just a couple of administrative items. One, everybody's joined in listen-only mode. If you do have any questions or comments, please use the questions box that is on the meeting control panel. I'm going to try to monitor those today. I'm presenting solo. Normally, I'm joined by an associate of mine. I'm presenting solo, and I'm on the road, so I'm doing this from a hotel room on a single laptop screen. So, but I will try to monitor the questions as they come in. So, oh, and the other thing to point out from a compliance standpoint is everything we talk about today is for education and informational purposes only. So nothing that we talk about today should be considered to be specific investment advice to you or your situation. For specific investment advice, you'll want to consult a personal advisor for your own situation. So with that out of the way, let's get started on what we're going to talk about today. And, you know, before we fully jump into it, I wanted to start with something that I think is true for every generation of investors, and that is throughout history, there's always been something happening in the world that's felt scary, unpredictable, uncertain. It was true after World War II. It was true in the dot-com bust. It was true with the financial crisis of 2008. And, you know, you might be having some of those feelings now with everything that's going on in the world. So there's always going to be headlines. What's kind of changed more over the years has been just how much those headlines hit us every single day, and the velocity with which they hit us through all of the different distribution channels for news outlets now. So it can be it can feel challenging and emotional at times, and we're going to talk a lot about that today. So the two things we are going to do today: first, I'm going to go through the scoreboard of what just happened with the investments, and the second, as I mentioned, we're going to walk through the headlines. So here we go. I'm solo today. So let's first start with that scoreboard. Here is what happened in the investment markets, just looking at some of the major broad indices over the first quarter. What you'll see is on the left, U.S. large cap stocks, which is measured by the S&P 500 index, were the worst performing of the major indices through the first quarter. Small cap stocks, U.S. small cap stocks were positive. International developed countries like UK, Japan, Europe were slightly negative. Emerging market countries like China, India, Southeast Asia, flat, as were bonds. And then if you look at the target date funds on the right, we're going to talk more about the target date funds in a moment, but you can see that, you know, the target date funds, which are really a blend of the different types of investment classes, you know, they were mostly down, but down moderately. So that's what happened in the first quarter. Here's just a little bit of a longer look, just looking over the last 1 and 3 years. So as you can see, over a 1-year period, there's still been very, very good performance, double-digit performance, high double-digit performance in most of the asset classes. And the same is true. The average return over the average annual return is what you're seeing for the 3 years. So the average annual return over the last 3 years for U.S. stocks has been about 22%. Small cap stocks, I think the interesting thing and the takeaway I want to point out here is really what's happened with small cap and international stocks, particularly in the last 1 year. What we've seen is that international stocks, which really underperformed US stocks for most of the last decade, have started to outperform. You saw that it was true for this last quarter. It's also true if you look back farther over the last 1 year. So we'll talk a little bit more about that when we get into some of the investing principles, but that is something that is going on in markets right now. You notice that bond returns are a little more muted on the upside, and the bonds, as a reminder, are the conservative portion of portfolios. So they're meant to provide protection during periods of time where stocks or equities are not doing well. Bonds are kind of the safety part of a portfolio, and that becomes more and more important as you get closer to retirement. And that's why you'll see these target date funds, the 2065, which is invested almost entirely in stocks, the 2045 fund, which is similarly has a vast majority, about 80–90% in stocks, and then the 2025 index, which has a smaller sliver. We'll talk more about that in a minute. But bonds, positive with meaningful returns, just not as quite as high as the equities are, and that's very typical for bond investments. So big takeaway of what's happening in investment markets recently: international stocks starting to have outperformed US stocks recently. And then there's also some more going on within US stocks. And what I want to point out here is that, if you've followed investments at all, you might be familiar with this. This is called a style box. So what it does is it breaks out large cap stocks, so large company stocks, mid company stocks, and small cap stocks. And then the styles are value, blend, and growth. And for all intents and purposes, I'm going to refer to growth as mostly tech stocks, because growth is very tech industry heavy, whereas value is more financials, industrials, and energy stocks. So one of the things, if you look at 2025, and this is really true too for a lot of the last decade, is that growth, just focusing on the growth stocks, have vastly outperformed value stocks. Also, large stocks have outperformed small cap stocks in 2025, and again, that was true too in the years prior. So large outperformed mid and small, growth outperformed value, growth or tech outperformed really everything else. Well, year to date, what we've seen is a reversal of that. As you can see, growth or tech suffered the most. Well, value, stayed flat, which was good in the period of time that we had. And also, small and mid cap stocks were positive, whereas the large cap stocks were negative. So we've seen that reversal of small and mid outperforming large, and value recently outperforming growth. And that's a good sign. When we see, one of the concerning things for markets was that a lot of the return over the last few years was very much concentrated just in technology. So when we see returns broaden out from just the largest technology companies, which you're all aware of, which they call them the Magnificent Seven, the Apples, NVIDIAs, Google, Microsoft. When we can see stock market returns broaden out from just those largest companies, that's a good sign for a healthy stock market. So just wanted to point out some of those trends, what's happened, and then some of those trends that are happening underneath the hood, if you will. And then, as I always like to wrap up this section every quarter with, is just a reminder of how target date funds work. This is an audience of retirement plan investors, and we know that many retirement plan investors choose to use the target date funds that are available to you in your retirement plan as your investment option. And the thing about, as a reminder, the thing about target date funds is what they do is they diversify your investments among all of those different things we just looked at, from US large, small, and mid. You'll have exposure to all. You'll have exposure to US and international stocks, and then you'll have exposure to bonds as well. And the way that the target date funds are designed is they're really based upon your time horizon until retirement. So someone close to retirement, so what might be invested in, maybe they're around age 65, invested in the 2025 funds. That investor is going to see that about half of their portfolio is going to be invested in bonds, the green slice here. Remember, bonds being the more conservative part of an investor portfolio. The other parts are going to, you're going to have about a third U.S. equities, and then about 16% in international stocks. A 2045 fund, which may be somebody at age 45, they're going to have almost 90% of their investment is going to be in stocks, with a mixture between U.S. and international. And then those age 25 starting off in their careers, maybe in the 2065 or even a 2070 fund, are going to have virtually everything in stocks or equities. The nice thing about the target date funds is what they do is they evolve as you get older. So once you're in this 2065 fund, 40 years from now is going to migrate to be more conservative automatically without you as the investor having to go in and do anything there. So just wanted to remind you of really how target date funds work and what they're, how they're structured and what their role is in the retirement plans. So moving on, let's now get into those headlines. What we saw in the last quarter, I chose 4 headlines that, that really dominated the news flow. The obvious one being the conflict or war in Iran, however you want to refer to it. The tariffs with the Supreme Court, tariffs were still in the news because of the Supreme Court ruling. AI disruption. What we saw, you saw earlier that technology had a rough quarter. One of the reasons why technology had a tough quarter is because there became a lot of concern about AI and how it might disrupt the technology and specifically the software industry. And then finally, the Federal Reserve, if you follow financial news at all, and it even makes mainstream media now, there's a lot of talk about the Federal Reserve and what the Federal Reserve might do to stimulate the economy or vice versa to reduce inflation. We'll talk about really what the Federal Reserve's role is and why what they do with interest rates is so important. So let's jump in and just talk about the conflict in Iran. Calling it a conflict here so the poli-sci majors don't get mad at me, because technically, as I understand it, it can't be a war unless it's been declared by both parties, US Congress and Iran. So it hasn't been officially declared a war, so we put conflict on the screen. Nevertheless, so what happened, this whole thing started around February 28th. It kind of peaked throughout March and then culminated on April 8th, slightly bled into this quarter with what is a ceasefire that's been coined as fragile, and I think we still wonder every day if that ceasefire is going to continue past the 2 weeks that expire this coming Wednesday. So that's going to continue to be a headline. But what I think the most important thing that I want to convey to you guys as retirement investors today is just that geopolitical events, they're very jarring in the short term, but history has showed us that markets recover a lot quicker than people expect them to. And one of the real reasons why that is that because even in the middle of a conflict, the economic incentives to resolve conflicts like the war in Iran, it's enormous. As we know, oil prices have gone up, and gas prices that we pay at the pump have gone up. Oil is used in the production and transportation of virtually every product that on earth that we buy. When energy prices stay high, it's a tax on everyone. It's a tax on consumers like us. It's a tax on businesses, and it's a tax on governments. So, us as voters, we feel it at the gas pump. So politicians know that they're going to feel it in the polls. And so the people in power have a real incentive around the world to kind of wrap these things up to be as disruptive as possible to their voter base. So, and that's just the reality of what really helps to resolve a lot of these events. And as you can see, as I mentioned, the looking at we have a sample. We did a sample looking back at going back to World War I of all of the different geopolitical events. And what we did is we have a subset here that you can see. We pulled out Pearl Harbor. So this is really the long one. It took from the time that the event started, it took 17 days to reach the bottom, and it took a full 200 days to come back to the level that it was at the beginning of the conflict. So it sold off, it was down 10%, 11% at the worst, and as I mentioned, up to 200 days. But if you focus on the highlighted line here, the point is that in the majority of scenarios, it's only about 17 days, a little over 2 weeks from the time that it starts to when the stock market bottoms out. And then the recovery is also just about 2 weeks to the time that it rebounds. And then if you look further forward, you can see that historically, markets, as they do, markets are typically positive 75% of calendar years. We've seen the S&P 500 have positive returns. So the important takeaway for investors is that you don't want to sit out. You don't want to sell your investments, sit on the sidelines, and wait for things to feel better. Because typically the markets rebound quickly, and missing the rebound can be devastating to portfolios. So here's a study that just looks at what would happen if someone missed out. I want to focus here first is, if you missed out on the 10 best trading days, this is investing starting in 1990, so 36 years of investing, starting in 90 and going till today. If you missed out on the 10 best days during that period, you would have seen a diminished return. If you stayed fully invested the whole time, you would have about 11% return. You missed those 10 best days, now you're down to an 8% return. Well, if you missed the 25 best days, you're down 6, and then finally, if you missed the 50 best days, you're down 3. But so missing out on those days can hurt you, and you hurt your returns. And the problem is the worst days, the best days typically come very shortly after the worst days. So if we look at the COVID situation in March, you had big drawdowns, 12% in one day the market went down. That's after going down a few days earlier, it went down almost 10%. So you had these really bad days, March 12th, March 16th. Well, right after that March 12th date, you had March 13th, which was up 10%. So really down 10 and then up 10 the next day. And then after March 16th, you had March 24th, which was up another 10%. So you saw it in 2020, you saw it in 2008 during the financial crisis. You see October of 2008, you had a negative 9% day, followed very shortly by two days that were 10% plus days. So it's rule number one, investment rule number one, don't try and time the market, because the rebounds happen quickly, and it's never going to feel comfortable if you step into the sidelines because you're concerned. It's never going to feel comfortable to step back in by the time the rebounds happen. So that's the lesson I want you to take out of the events that I ran. The second thing that happened, and this happened in early March, is that the Supreme Court reversed about a third of the administration of the tariffs that the administration put into place a year ago. Now, normally, I think this would have been a much bigger headline, but it kind of got overshadowed by the war. And that in itself is kind of evidence that the market can only handle so many headlines that are coming at us every day. And I'm not going to talk a lot about this because at the end of the day, what ended up happening is the administration has moved quickly to recategorize that $100 billion of tariffs. They've moved quickly, that was overturned. They've moved quickly to recategorize that and move it under different legal authorities that are more defensible for the administration to keep those tariffs in place. So at the end of the day, it's not going to have a big impact on the budget, and that's what really this whole thing was about. This whole thing was about U.S. debt levels, which we know are already high, and these tariffs, which are going to be revenue, money into the country to help hopefully reduce and pay down debt. If those tariffs went away, if a third of those tariffs went away, that means less revenues coming in, and now we start to worry more about our country's debt. And when that happens, the perceived value of our dollar, the US dollar, if our debt levels get out of control, or if the market and investors and other countries perceive our debt to get out of control, we can see a decline in the value of the dollar. And what most investors don't understand is that when the dollar weakens, that is generally can help boost foreign investment returns. So that's one of the reasons why international stocks have outperformed US stocks over the last year. It's because we saw a decline in the dollar, which helped boost international returns, seeing international markets outperform US. So the lesson I want to take from that to convey to you is that as an investor, it's important to avoid home country bias. It's very easy and comfortable to invest in just the US markets, because if you look at what you're invested in, you'll recognize a lot of the names. You'll see the household names that you use every day, and it feels comfortable to be invested in those. But over time, you're going to miss out on returns that have come from overseas and international markets. And when we talk about the tariffs, really the impact of those tariffs has to do with the impact it has on trade, but also on the US debt and therefore the dollar. Lesson to take away from there is don't avoid home country bias and make sure you're diversified into international markets, which if you're invested in the target date funds, you will be. Third headline I want to hit on is what I mentioned, AI disruption and the software sell-off. So, starting this quarter, investors began to worry that the AI, because it's becoming cheap, quick, efficient, may start to replace some of the software companies, software services, the enterprise SaaS companies, software as a service, because frankly, if companies can do things cheaper with AI tools, then maybe they don't need to pay $30 a month for subscription software for every employee that they've had forever. So you can just look at we throw out names like Salesforce and Adobe here just because they're examples. Salesforce and Adobe are considered to be, if you would think a couple of years ago, those are companies that had we considered wide moats. They had huge competitive advantages against their competitors. They had a lot of pricing power because companies were really tethered to them. And you would have thought, there's no way that you're going to see a sell-off in these companies. Well, you did, and it's not just these companies, because we're not commenting on any specific company stocks, but it was the software industry as a whole. And it's a reminder for investors that when you concentrate yourself, certainly in any one company stock, which sometimes can happen and I know it's not for those of you on the line, but maybe you have a spouse or maybe you worked for a company before that had RSUs, or they had company stock in the 401k plan, and maybe you accumulated a lot of company stock while you're with those companies, and all of a sudden you see that one specific company or even one specific industry starts to represent a large portion of your net worth. That can be problematic. And you can see, the software industry in particular, it's not the first drawdown that it's had. It's had other drawdowns over the last 30 years. This most recent one, a 28% drop if you were, invested just in software companies. So, it's software right now, and software has always been a volatile category in itself, but it could be any industry. Industries, by and large, any one industry can be impacted by events that are outside of it that cause these kind of sell-offs. So that's rule number 3, diversify. Rule number 3, diversify, don't concentrate in any one company or any one industry. And the final headline, as I mentioned, is the Federal Reserve. The Federal Reserve is always an underlying headline for investors, wanting to know if and when they may increase the federal funds rate or decrease the federal funds rate. As a quick recap, Federal Reserve, it is the authority within the government that has a mandate of kind of steering the economy. It has what's called a dual mandate. The first mandate, their first job, is price stability. That means control inflation, keep the prices down. Their second job, maximum employment. That means promote job growth. Healthy economy, companies hire. Hiring means we have more money in consumers' pockets. Consumers go out and spend, and companies make money. The federal funds rate is the primary lever that controls how they regulate the economy. The federal funds rate, to keep it simple, is the rate that the government lends money to banks. If the government's lending money to banks at a lower rate, it means the banks can go out and lend more money at a lower price to us as consumers, and we as consumers can go buy more. The opposite is true if the federal funds raises its federal funds rate. Banks are going to lend less, and then consumers are going to spend less. So they raise the federal funds rate, which is what they have been doing recently when they get worried about inflation. Too many people are buying stuff. Prices are going up for that stuff. So they've been raising the federal funds rate because they're concerned about inflation. Inflation has started to trickle down, but recently, because of the war in Iran and what's happened with oil prices, the Federal Reserve is now a little more concerned about inflation. So they're in a kind of a wait and see period right now. Really kind of in a rock and a hard place, if you will, because they have, we've seen a little bit of cracks in employment. We've seen an uptick in layoffs, which, from a job growth standpoint isn't good, but we also haven't seen inflation come down to the point. So the Federal Reserve is really waiting to see which way to lean, and that's going to continue to be the story over the next couple, it's always the story, but it'll particularly be the story over the rest of this year, especially there's a new head coming into the Federal Reserve, a new Federal Reserve chairman coming in a couple of weeks as well. And the reason why the Federal Reserve and really the economy is the message here. What's important for investors is to focus on what's actually happening with the economic fundamentals, and more particularly with earnings in companies. And let me just kind of make the points here that what you're looking at is the US economic, this is the surprise index is what actual economic data is coming out, and is it better or worse than what economists, so this is what a survey of professional economists, they make their predictions. So these are economists, they do this every day. They make their predictions. And then this index here is a surprise index. So when you see a positive here, it means that the actual economic data is coming out better than what the economists predicted. And I think this is important because sometimes as investors, you get caught up in the moment, you get caught up in the emotions, whether it's political emotions, events that are going around the world, headlines that you hear, and in your mind, you think that the economy must be doing terrible, and the economy must be performing poorly. And often it's not the case. Even the economists have a hard time predicting what's actually going on in the economy. So separating your emotions from what you perceive to be and focusing on data is important. And the reason why the economy is important is because the economy is what drives, when the economy is healthy and thriving, as I mentioned, us as consumers, we're going out and spending. And when we're spending, that promotes earnings. We're spending this money with companies that now are bringing in more revenue, they're making more money, and earnings are what's most important to companies, to the stock market. So you can see here the S&P 500, which is US large cap stocks, and below that you can see, or the dark line is what earnings growth. Are companies seeing their earnings grow? And you can see that they move pretty much in lockstep. When earnings are growing, companies are doing well, the underlying stocks are going to do well. And that's the most important thing for investors and for investment returns, more than a lot of the things you're going to hear around you. So those are the four headlines translated back into 4 kind of principal rules that we think are important for all investors. And I'll just, again, recapping those rules. Don't try and time the market. The best market days come pretty short after when the pain is felt the most. Avoid that home country bias, diversify globally, even though it's the natural tendency might be to just stay with what you know. Avoid concentration. So diversify, make sure you're not overly invested in one company, one industry, as an overwhelming portion of your overall wealth, because there's a lot more volatility, a lot more risk when you're concentrated. And then, if you are trying to make assumptions about what's going on in the investment markets, look to the actual data, look to what's going on in the economy, and look to what's going on with corporate earnings. A lot of people would say the stock market is due for a sell-off right now because it's gone up for so long, and maybe valuations are high, but a lot of it is because the earnings growth that we've seen recently has just been it's been record-breaking, and so that's been part of the story of why, yes, the market has gone up a lot and over the last few years, and a lot of it is warranted based on the earnings growth that we've seen. So hopefully these are lessons that you can remember when you're making decisions about how to invest your 401k, maybe how to invest outside of your 401k. Welcome any questions you have. Again, please use the questions box. Before we break, I just want to remind you that we have next month, we're going to actually be tackling, as we get towards the end of the school year, we're going to be talking about planning for the expense of college. So if you have kids, grandkids, and are just wondering what's going on with college tuitions, and how am I going to pay for this? What are my options? We're going to talk about saving and investment options. We're going to talk about scholarships, grants, financial aid, and what's going on there. The following month, we're going to talk about the housing market. We're going to talk about not so much about the housing market, but we're going to talk about how to think about home purchases, real estate as part of your overall financial plan. And at the end of the second quarter, we'll circle back and talk investments again. So again, I want to thank you for your time out of your day today. And if you have any questions, I'm trying to monitor the box here. I don't see any questions right now, but feel free to reach out to us. We're here to be a support to you. So if you do have any, you want to set up a time to talk one-on-one, feel free to reach out to us, and we can set up a time for you to talk with one of our advisors one-on-one about any questions you have about your financial life. So again, thank you for your time, and have a great rest of your day.